It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital Lending. And joining me today on his own podcast, Mr. Michael Becker. Michael, how are you?
Hey, Paul. How's it going? Doing good over here.
Groundhog Day every day for the last, 6 weeks. I'm dealing with my warden wife. She is creating menus on a weekly basis about what I can look forward to on Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, and Sunday. So she has us locked down, and I'm starting to see a little bit at the end of the tunnel. And how's it going over there? And are you seeing a little bit of light at the end of the tunnel?
Yeah, I mean, the other day, the governor, as we record this, the governor kind of had the open up Texas plan. So I think Texas looks like we're going to be one of the, if not the first, one of the first to kind of loosen up some restrictions and get people back to work, which I'm certainly looking forward to going back into the office and getting out of my house. So I think that'll be great once we kind of get back at it. So I think, schools have officially been canceled for the rest of the year. So we're all kind of stuck here for a little bit, at least my wife and my kids. So it'd be nice to go out and escape that a little bit. And hopefully this summer we can still get out of town and avoid some of the heat, because it hasn't been too bad because the weather's been actually pretty nice. But I can only imagine being stuck in the house. And when you go outside the house, it's 102 degrees and humid. So I'm looking forward to getting out of town this summer if that's at all possible.
Your wife is an elementary school teacher. What's harder for her, having her teach 30 children in the classroom or her two lovely children at the house?
I think the frustration level is greater with the 2 than it is the 30. So that's for sure. So you definitely appreciate our kids' teachers much more than I did, 6 weeks ago when all this stuff kind of started.
Absolutely. So there's two things we wanted to remind you of. One is that whenever you have a chance, if you could, go into the Old Capital podcast and leave us a 5-star rating. We certainly do appreciate that. We're trying to get 1,000 reviews by the end of the year. Whenever you have a second, we do appreciate going into iTunes and leaving us a 5-star rating. We certainly would appreciate it. Again, we do talk with Michael. Michael has kind of a unique experience. He has been buying apartments for a longer period of time than most. He's been in commercial real estate lending prior to buying apartment buildings. He was his top producer of the commercial real estate lending department of one of the largest banks in the United States. And so I think he led his division over 400 or 500 people for a number of years, did billions of dollars in loans. And so he has a great, unique perspective, not only on lending the money, but actually owning the real estate. So his group over at SPI, they own 6,000 plus stores. Michael, am I saying that right?
Yeah, we today we own about 6,000 doors. We've probably done nearly 10,000 in my career. So we've gone full cycle on several. We should have gone full cycle on more, but coronavirus came up and stopped a handful of those right at the end.
That's right. And so we get Michael's insight about a little bit about what's going on. So we do definitely appreciate Michael spending some time with us. So we did a conference call. Well, we had probably about 1,500 people that had registered for that event. It was a kind of a co-partnership with Marcus & Millichap. So Nick Llewellyn, who kind of leads Marcus & Millichap, not only in the Dallas office, but for Texas and throughout the nation. We got on the horn with him, and he had a couple of his folks. One was an economist, and the second one was heads the national production. So John Chang is the economist for Marcus & Millichap, and you may have known John by anything that he has written about apartments. He does a great job of kind of trying to keep everybody informed. And John Sebring, who joined us, and he kind of talks a little bit about kind of the bigger picture throughout the country and how apartments specifically are being affected. So it was a good conference call, but unfortunately, we only wanted it for 60 minutes because we wanted to get so much information on. But we had people on the call that had lots of questions, and so we weren't able to get to a lot of those questions to be asked. And by the way, Michael Becker was on that call, and also the professor James Zhang with Old Capital to answer questions. So I thought this would be a good platform to ask Mike those questions. And so I'm going to ask Mike maybe 1 or 2 or possibly 3 questions, and we can kind of keep going. So, Mike, if you're up for that, let's kick it off here.
Let's do it.
So what is happening with quarterly/monthly distributions? Is there a mathematical formula on how much you need to retain and how did you figure it out? So I think those are that's one question. So let's see if you have an answer to that, Michael.
Yeah, I think basically what happened, Paul, was we got into late March when all this stuff was really kind of hitting pretty hard, and we decided that across the board we're just shutting off distributions. So just kind of turned it off for the foreseeable future, and I think that's what most people probably did. Basically we decided that we needed to retain as much cash as humanly possible, kind of as we were entering into the abyss and not quite sure what collections would look like. So fortunately, now that we're through the majority of April collections as we record this, wasn't anywhere near as bad as we kind of feared in late March. I think at the end of the month, we'll probably finish somewhere in the 3 to 4% delinquent portfolio wide. Each asset, some are going to be better and some will be worse, but overall, kind of that 3 to 4%. I think a normal month we're somewhere south of 1% delinquent. So you're probably talking 300-400% greater delinquency than typical. But all things considered, with 20 plus million people unemployed in the last month or so, to have only 3 to 4% delinquency, I think everyone is certainly have a big sigh of relief and counting their blessing that's a huge win compared to what we feared it might be. So that's kind of what we did. I think we probably have at minimum April, May, June, probably even July turned off, and then we'll probably reassess kind of where we sit. Most of the assets were certainly our delinquency is going to be much less than what we pay out on a monthly basis. So we should, that coupled with us kind of doing our best to do some cost containment on the site level, turnover costs will be lower. So make ready costs will be down. The repairs and maintenance most likely will be down, maybe a little bit less in payroll. And we're trying to negotiate as many service contracts as possible to try to get some at least temporary relief to some of the service contracts like landscaping or pest control in particular, because you're not going into as many units with that. So we'll have some lower operating expenses. So we should be accumulating some cash that hopefully we won't need. So I think once we kind of get in the backside of this, we'll kind of look at where we were going in this from a liquidity standpoint, where we kind of come out of a liquidity standpoint, and then if we feel like the all clear sign is kind of there and we're starting to get back to normal, we don't feel like we will need this money, we'll turn back on distributions. To what timing and to what the exact mathematical formula is, I'm not quite sure. We'll definitely want to make sure that we kind of got the all clear, because trying to go get future money from investors once you pay it out is going to be next time possible. So we're just trying to do the right thing for the asset and make sure we have plenty of liquidity set aside to deal with whatever comes our way.
So just anecdotally, I mean, good for you, fantastic for you, great for the assets that you have in your portfolio, but I'm not hearing that in other parts of the country. I mean, what are you hearing for areas of Orlando or Daytona Beach or Los Angeles or New York? I mean, how concerned are you with those collections for April and going into May?
Man, if I owned a property in Las Vegas, I'd be I'd be scared right now. Because basically the entire economy was or the vast majority of it was tourism related. So I think the same with Orlando to the large extent, and some of those coastal markets like you mentioned, and or if you're in like New York or was this certainly been hit the hardest of anywhere in the country, just due to the density in the public transportation system spreading the COVID-19, or if you're in LA where you're already had pretty tough, from the landlord's perspective, pretty tough tenant landlord laws out there, and you're hearing calls for national rent holidays and tenants going on rent strikes and stuff like that. That's a lot bigger concern if you own an asset in Southern California than it is in North Texas for sure. So I think they're going to see a lot more disruption in their income stream, and I think they're going to have a lot longer road to hoe than some that owned a property in Texas or Georgia or Phoenix, Arizona, or someplace like that had a little bit more of a diversified economy that's a little bit more landlord friendly from the law perspective. So I think every area is going to be a little different, obviously, and every asset's going to be a little bit different. But I think hopefully by the summer, as we record this kind of in late April, I'm hopeful that by the summer we can kind of turn these back on, and to some level, I'm sure we'll be pretty modest in the way we turn these back on. But I think we should be accumulating, if everything kind of holds from April going into May, which is a big unknown, right? We all think May is going to deteriorate just to what percentage and degree does it deteriorate will determine the level of distributions and then the timeliness of when we turn distributions back on.
So if you've been watching CNBC, you see a lot of the presidents and CEOs of the companies getting on, maybe, every once in a while on CNBC telling the audience about what's going on. But Michael is the king of communication when he's talking with his investors, just kind of giving them an idea about what's going on. And so think of having Michael on CNBC once a day or 3 times or 4 times a week. That's the level of communication that he is pushing out to his investors. But one of the question that came up, which I think is absolutely relative, is what type of information do you give your biggest investor? And I'm not talking about one of those limited partners that's put in $300,000, $400,000, $500,000. I'm talking about the lender that wrote you the loan for $12 million or $6 million or $1 million. What type of information, Michael, are you telling the lenders these days, and what do you share with them, and what are the KPIs and how often? So there's a lot of questions in that. One question is that what are you sharing with your biggest partner?
I think when we were going into this, Paul, we shared some basic information kind of as we were in late March. So we sent a T12 through February, a current rent roll as of late March, and a balance sheet that kind of showed our current cash position and payables. So they kind of knew where we sat financially going into the abyss, as I called it. And then now this week, I'm planning on sending a collection updates out, probably tomorrow, which will be Monday as we record this. So I'll send them out kind of where we were on collection, so they kind of get a sense of that. So I'll send that to each one of my asset managers at the bank or portfolio managers at the bank, so they kind of get a sense of where we sit. And fortunately, I think everyone's going to be pleasantly surprised. So kind of like I said, where we feared we'd be, back in late March. So I think that's certainly something I'll do. I'm going to send them, a monthly T12, a monthly rent, on a monthly basis, a T12, a rent roll, and a balance sheet, kind of showing, liquidity position and payables. And then from there, if they have any questions, we'll certainly answer them. But I think if you can communicate on a monthly basis that basic level information, T12, rent roll, and a balance sheet showing your cash and payables position. And then if you have any sort of narrative or kind of collection percentages, I think that would certainly be a really good thing to do. And then as you start getting into trouble, they kind of see where you are and then kind of see it coming. And I think they'll be a lot more apt to work with people that do that than those that kind of the people that stick their head in the sand. I think this is going to go away, whether that's from your lender, your passive investors, your vendors that provide you services on your property, or your residents or your staff. These problems aren't going to go away. So I think, our motto and what I learned from, 12 years ago was the people that kind of took the problems head on were the ones that had the best chance of success. Those that kind of ran and hid from it, those are the guys that got wiped out.
I mean, that's certainly true. About 12, 13 years ago, when we were just starting this great pullback before, during the subprime business that kind of affected commercial real estate. 2, you were a banker, and as a banker, you kind of were the guy receiving all of these reports from all the operators out there. So you kind of knew what to expect and what you should be pushing out there, what the operator should be pushing out to you. And now you're an operator, so you know what the banks are going to expect. So, I mean, the bankers are kind of going to divide you up to just like a stoplight, a green, yellow, and red, to kind of figure out what's going on. Not only do you have an obligation with the lender to explain what's going on, I would be on the forefront of having almost weekly conversations, pushing over collections and pushing over the things that Michael had spoken about, just to get ahead of this. Because if things were to go bad, they've got to understand a little bit about where you're at, so they can kind of balance their portfolio, what to work on, what to not to work on, at least right now, and kind of understand is that, are you going to be a problem for them down the road? That will come back in spades to help you out in the future. That the bank wants to know that you are flexible and wanting to be proactive in sharing that information. So if you're sharing information to your limited partners, make sure that you share that information with your lender too. Michael, this is kind of a side bonus question. Let's say we do have problems down the road. At least there's a forbearance agreement on Fannie Mae and say Freddie Mac's side. And some of the banks, using your past knowledge and wisdom, we're able to handle forbearance agreements on the banking side to put those payments on the back side of the loan. Do you see an opportunity on the CMBS side? Because the CMBS side is what we've seen is not going to do a forbearance and they're not going to put those payments on the back of the loan. Is that something for people to start to think about?
Those are where I think the cracks are going to be. And, I think generally speaking for the multifamily market as a whole nationwide, there was very small percentage of the debt was actually CMBS. So this entire cycle or entire previous cycle, I guess now at this point, if you wanted a loan, I mean, Fannie, Freddie, the banks, Life Cos, all those were a lot more willing to work with you versus the CMBS. So if you went to CMBS, there was a reason why you went to CMBS. So it was something with a physical asset or most likely the market that you were in. So you were in Midland, Odessa, or you were in some market where the agencies or regular lenders didn't want to go. So I think those are probably where the concentration of the CMBS loans are going to be. Not saying there aren't some in Los Angeles or Dallas or Atlanta or wherever. There certainly are. And those are the ones that are probably going to have the most problems because there's probably something fundamentally wrong with that asset going into this, where they had to go to CMBS because no one necessarily chose to go to CMBS. It was there for a reason because the traditional lenders don't want a loan on it. So to the extent there will be distress, I think it's going to be concentrated with the CMBS lenders and the high leverage debt funds. Those are where you're going to see problems. And it was probably because the asset had a problem even in the best of times. So that's where the distress is going to be. And I think if you can focus on assets that have the CMBS loans or the high leverage bridge loans, those are probably the ones they'll most likely be the ones where you can potentially buy from the lender at a foreclosure or maybe buy a note and you go out and you go take the asset back on the lender's behalf, maybe buy the note at a discount or something like that. So I think we're still many, many months away from that. I don't think it's years away, but it's probably many months away from the first ones of those kind of really rolling out in the marketplace.
Absolutely. And if it's not multifamily, it's in other property types like hotels.
Yep. And you want to go buy a note on a discount on a hotel or a retail strip center, I'm sure there'll be a lot more of those opportunities than there will be in the multifamily space.
Absolutely. So some great information about what's going on today. Michael, can you just give us a little bit of a background on what SPI does?
Yeah, if people want to find more information about what we do, the easiest way is simply go to company's website, which is www.spiadvisory.com. It's SPI like spy advisory.com. There's a contact us form. Fill that out, and we're always happy to set up a conversation with people we meet off the podcast. Paul, we do two things. I think when kind of hopefully we'll come out of the back end of this, and we'll be probably very little opportunity for the next several months, just what I just kind of stated. But what we primarily focus on putting together high quality deals and going out and raising capital by syndication. So if you guys want to get on our list and get more information, that's the best way about going about that. Where hopefully in the third and fourth quarter we can start getting some opportunities again, which will be a nice refreshing change from what we've been doing the last 30 days. Or if you're a high-net-worth person that has $5 million or more in equity to put together towards a deal, we also do advisory services where we can kind of help on a one-on-one basis put that capital to work. Whether it's a 1031, which I think we're not going to see a whole lot of 1031 business for the next several years, just kind of wrap up what's currently in process, and the 1031s will be gone for a while, or you just kind of have some liquidity. You've been sitting on the sidelines for a long time, waiting to kind of put that money to work. And you want to come to Texas and you don't have, and you want to leverage our relationships and experience in the marketplace. That is certainly something we can do as long as kind of the equity checks about $5 million or more, Paul.
Yeah, but you're not a broker, so you're not brokering the transactions. You're helping folks kind of hold their hand through the entire deal. You help them find the transaction, get it financed, asset management. You bring a heck of a lot of knowledge to help, value-added knowledge to help folks that may not be familiar with multifamily.
And implement the business plan, the whole thing.
That's unbelievable. So good for you that you guys are doing that. Don't forget the 17-page white paper report on lending was written by James Zhang, the professor. Michael Becker contributed. Again, it's Multifamily 101 Financing. Go on to the Old Capital Podcast website, Old Capital Podcast website. I want you to download that and read it. because the lender is your biggest partner, and you want to know how to treat them when we're originating these loans. Second thing is on the Old Capital Podcast website, James Zhang, the professor, has put together a series of videos that I think are just outstanding. Talk a little bit about how do you raise money through this tough time, what's going on with operations, what's going on with management of these properties. So he's gone into great detail. I encourage you to go on the Old Capital Podcast and download or watch some of these videos. There's got to be 10 or 15 or 16 videos. So they're probably half hour a piece, but some great information coming out of the professor. So please do that. Again, Michael, I think we're done. I appreciate your time and look forward to our next Ask Mike Mondays. Again, that's Michael Becker. I'm Paul Peebles. Have a great day.